Hey guys, how we doing? So Dan from Trading with Dan here. So in this video we're going to look at momentum and volatility. So momentum. It is possible for a trader to gauge the strength of a trend and its ability to continue or reverse based on price action alone. This can be done by looking at the momentum indicators. If a trend moves on strong momentum, then it will typically lead to further continuation. If a trend moves on strong momentum, it basically means traders are rushing to buy that underlying asset in that direction of the trend, or sell it if it's going down in that downwards direction of the trend. A trend can move on weak momentum when there isn't a lot of interest in the asset, or maybe it's drifting counter trend to the original moves, but obviously that's not going to necessarily see the same continuation as a trend that has a stronger momentum. So you can see in this example, the price has moved up on weak momentum. You can kind of see it here. It's moved up on weak momentum and then moves down with strong momentum after a period of consolidation. You can see it also most notably here. So the price has moved down. It's then sort of taken a break moving down. It's sort of drifted up on weak momentum and then gets a strong downward candle and then gets some strong downwards movement. So yeah, that's kind of how markets will often trade. So you can see here we had these strong moves down, a bit of a consolidation, low momentum, strong move down, consolidation, strong move down, a bit more consolidation for a longer period this time, but it's not like a violent move up like we're getting down, and then strong move down again. So you can kind of see that's how momentum and the actual momentum of a move can tell you whether it's going to keep going in that direction or not. So subsequently you can see that a move on strong momentum is a catalyst for a larger move down in the price of an asset. So you can see here, this is obviously continuing on from what we saw in the last picture here. So we had this move up, we had this big strong candle down. Right, so then what happens afterwards? There's that candle. That candle basically starts off a big sell-off. So we have that strong candle on momentum, and that then momentum gives the price action follow through to the downside, and we then get this large move down. So momentum reversal. So you need to consider what stage within the market's overall structure the high momentum move is occurring in. If the uptrend, for example, has been in progress for a prolonged period, then a bullish strong move up may mark the transition from the bullish move and the start of a more prolonged bearish move. It is not uncommon at all for a trend in price action to be terminated by one last strong momentum move in the direction of the trade. This is how doji candles and other bearish looking candles with long wicks are formed. So we can kind of see it happening here. So at place number one, this is sort of the story of the price action of what is going on in the price. So at stage number one, traders have identified a potential uptrend developing. So after retracing, so we have a bit of a move up. So after retracing, the market makes a strong move up, as you can see at this point too. Price again then retraces and consolidates, and then price then makes a final very strong momentum move up in 4, and at that point that signals the top of this move, and then we then start to move down. But you can see how this is the most violent big move up in the trend, and that then does signal the end of the trend. But also you would note that this came after 1 push up, 2 push ups, and it was the 3rd push up. So we had a few push ups in this trend. So the trend, you could say, was getting a bit long in the tooth. So this big blow off top was the point that the trend then did finally reverse and start to go the other direction. So volatility, right? Price volatility is a measure of how much the price fluctuates over time. A period of low volatility can be identified when the volatility over the immediate period of time is lower than the historical average. Periods of high volatility can be emotional times for traders, with many attempting to put positions on in the direction of the high volatility. Periods of low volatility, on the other hand, can be uninteresting times for a lot of traders, and that can be also be accompanied with low volume, but though it can present opportunities. Typically, price will cycle from low volatility to high volatility to low volatility. And this is a saying that I always say: high volatility leads to low volatility, leads to high volatility, leads to low volatility, and so on. So, how to trade volatility? When volatility is high, it is sensible to wait rather than immediately enter a trade. Once you wait for the market to move, on a lower volatility, it may be time to make a prediction on the future price movement and identify price points of liquidity to more carefully enter a trade. So you need to look for factors of confluence such as the price action, candlestick analysis, volume spikes, momentum, and chart patterns. Right, so here's an example of price action moving from low volatility to high volatility in the direction of an overall downtrend. So you can see we've got low volatility here. We then get a strong momentum move down, obviously on a lot of volume, and then we then get a big move down. We then get some more volatility towards the end of that move, and then we do sort of slow down and consolidate. We then get another bit of volatility where we move down, not as much volume this time, not as much volatility, but some volatility nonetheless moves us down. We then consolidate again in a period of low volatility, and then for a third and final time we get the big move down. This is often how markets will work. You get like a 1 push, 2 push, and then the final push can often be the biggest push, like we saw in the previous example. So this high volatility move down on the highest volume, look, that we can see here in the volume indicator. So here's an example of price action moving from low volatility to high volatility, but not typically in the same direction, actually in the opposite direction. So these are the sort of Bitcoin bar patterns that we talk about. So we can take this one for example first. So we get the move down, high volatility move down, we then get a consolidation, and then we get a big move up, so in the opposite direction to that initial move down. We then get some consolidation, and then this time we actually do get a move up with the original trend, and then some low volatility, then a move down the opposite way till we came up. Obviously down is opposite to up, then consolidate a bit and then back up in the same direction, consolidate a bit and then back down. So you can see this is typical of Bitcoin price action. We'll push down then go up, and push up and then go down. We don't really go down there, but then push up and then go down, then push up and then push up and go down. It is typical of Bitcoin price action. Right, so a disciplined trader will wait for market conditions to be favorable before executing trades and will not likely enter trades when many retail traders are. So what this is saying is you'll get a lot of traders that will see the volatility and then start to jump on the back of that trend or jump in the trade, and that's where more sensible traders probably don't enter trades. They may exit trades or they may already be in trades by that point, but they're not necessarily looking to enter at that exact point. So an undisciplined trader will often enter trades when market conditions are not favorable, such as in periods of high volatility, and will often act with FOMO, which means fear of missing out. So when they see that big volatile move up, they want to buy and buy and buy because they want to be involved in the big move up, and that's called FOMO. And often the price can retrace and they'll hit their stop, and the market can completely reverse, in which case they've been buying at the highs and the market then starts to come down. So they are all things that less experienced traders can do and that you just want to avoid doing. So you do want to really wait for periods of low volatility and then plan your trades. Like we talked about in the previous video, plan your trades based on other market indicators, on candlestick analysis, on patterns that you see are potentially bullish or bearish. Look for liquidity pools, look for stop loss hunts, and then that's how you want to enter a trade in a period of relative low volatility. Right, so thanks for listening guys, and I will catch you on the next.